Alright guys, I found this article which I think is a really good follow-up to the article I read last week for my segment on things I don't understand. And if anybody watched that, it was about the relationship between the federal funds benchmark rate, the rate as well as the rate that the Federal Reserve pays on excess reserves, and the relationship between those two and why that might raise concerns about liquidity and why it might stop the unwinding of the Fed's balance sheet. So here's another article on the subject that I think does a better job of breaking those topics down a little bit better. And I'm going to read it out. I'm going to read it out loud for you, and hopefully you find it interesting. Read it as quickly as I can and still be clear, and then I'm going to talk about it paragraph by paragraph after that. Along with an expected rate hike in December, some central bank watchers expect the Federal Reserve to approve another tweak to ensure that its current policy path, which has come under increasing pressure, proceeds smoothly. If the Fed is unable to manage the range where it keeps its benchmark interest rate, that could lead it to halt the unwinding of its balance sheet comprised of bonds it purchased to lower mortgage rates. The economic and market ramifications could be substantial. The market has long been expecting the Fed to go through with a 25 basis point increase in its benchmark fund rates at the year's final Federal Open Market Committee meeting. Under normal circumstances, such a move would be accompanied by a commensurate quarter-point hike in the interest the Fed pays on excess reserves from banks, or the IOER. The current level is 2.2%, compared with the 2% to 2.25% range for the funds rate. However, the funds rate has risen near the top boundary of its range to 2.2%, equal the IOER, and that presents a problem. The Fed uses the IOER to guide the funds rate, generally as a floor for where the funds rate should be. The central bank manages its funds rate through the interest rate on reserves and its overnight repo facility, which also helps the Fed to set a floor on rates. This year, as government debt issuance has surged and rates have increased on the repo purchases in which the Fed has purchased, the funds rate has drifted to the upper end of its target range. Back in June, the Fed addressed this issue by raising the IOER just 20 basis points to try to push the funds rate more toward the center of the range. That worked for a few months, but the two rates have drifted closer together, and on October 23rd, met at 2.2%. The Fed has lost control over rates, says Michael Pierce, senior U.S. economist at Capital Economics. Though none of this is too troubling for the Fed as long as it's able to manage the funds rate back down to the middle of the range. Fed officials did not respond to a request for comment. With reserves abundant, it is unlikely that the effective funds rate will rise much above the IOER. If it did, however, the Fed would presumably conclude that there was less excess liquidity than previously believed and, as a result, bring its quantitative tightening to a premature end. Importantly, Fed officials noted in minutes from their last meeting that the rise in the funds rate did not seem to emanate from a lack of reserves, which would be more troubling. The Fed is allowing up to $50 billion worth of treasuries and mortgage-backed securities to run off of its balance sheet each month in an effort to reduce the bond portfolio from its $4.5 trillion peak, with the current level at $4.2 trillion. Indications that reserves are tightening and pressuring rates higher might push the central bank to ease off the balance sheet reduction. The issue arises at a time, however, when the Fed is facing increasing scrutiny. However, the September FOMC meeting summary noted that the balance sheet program has produced a muted market reaction so far. Whether that continues, though, could depend on the relationship between the IOER and the funds rate. Citigroup economist Andrew Hollenhorst said he even has fielded questions about whether the Fed might cut the IOER rate to 2.15%. Cutting such a policy rate in the middle of policy normalization would present drawbacks, so we think it's unlikely. In the wake of recent volatility in the market, traders have reduced their probability of a December funds rate hike to 74% from 87% a week ago. The probability of a March 2019 increase is down to 48% from 62% a week ago. Now, I have to say, that is the end of the article, and this author put a lot of information in this article, so credit to Jeff Cox. Lots of stuff packed in here, so I'm going to go through it sort of section by section. So as I said, this article is about the Fed being unable to manage the range where it keeps its benchmark interest rate, a concern that it's drifting to the top of its range, and I believe the top of the range is 2.25%. And so the federal funds rate is now creeping up to the rate that the Federal Reserve pays on excess reserves to the banks. And I infer from this article then that the IOER is supposed to act as a ceiling on the federal funds rate, and well, no, that doesn't quite make sense. It should act as a floor. If we're thinking about this, I mean, the Federal Reserve could influence interest rates by paying banks an interest rate on the reserves that the banks keep with them. That would sort of set a minimum interest rate that any bank would want to accept before it lent out its money. Because why would it take any risk when it could get the same interest rate without risk by just parking it at the central bank? So there's just another piece of this that's just not clear from this article, which is why is so the funds rate, this article and the previous article is talking about the funds rate rising to the top of its boundary rate, where it's now equal the IOER. So I don't know. There's something inconsistent here. On one hand, it's talking about the funds rate near the top of its range, and on the other hand, it's talking about this IOER, which is generally a floor. So it must mean. I mean, the IOER should act as a floor. So if the IOER is 2.2, well, I think there's obviously more to this I don't understand. There's more to how the funds rate is set and where it is expected to be. I mean, it's supposed to be between 1.75 and 2.25. I can tell you that much. 2.2 to 2.25 is the federal funds rate. And I guess they're expecting that the funds rate should be a bit lower. And now I don't understand why they expect that. So there's some piece of this I'm still missing. And so when they lowered the IOER relative to the funds rate in June, that they says that seemed to work to keep the funds rate down. So there's just some piece here I'm not quite understanding. It seems as if somehow the IOER is expected to act as something of a ceiling here, and that's how it was. They tried to use it in June. Okay, so anyways, now one thing I do understand from this article is that the relationship is a little better anyways, is the relationship between the IOER and bank reserves, because I guess, but not quite, but I understand a piece of it here, which is if the bank has, I guess, more reserves than it should go the other way. So they're concerned about missing or deficient reserves, that they're concerned. Okay, where was that guy's quote? Here, this was Michael Pierce. With reserves abundant, it is unlikely that the effective funds rate will rise much above the IOER. Now, I'm still missing an important piece here, but I think I've gotten closer. Because that I don't understand that point. Why is that the case? What is that relationship there? Because Pierce is saying here, if it did, we'll just say if the Fed funds rate did, then the Fed would conclude that there was less liquidity than previously believed. Yeah. No, not any closer. I mean, I think I understand some of the elements a little bit better from this article, but still missing that central piece of why the effective funds rate is going up exactly, why people believe it's from a dearth of reserves, to the point where this gentleman says the Fed would just would presume, he's presuming that they would conclude that there was less excess liquidity. So why would excess liquidity keep the effective funds rate down? I mean, I understand this last piece, why the quantitative tightening would come to a premature end if there was not as much liquidity. Then the reserve's going to get nervous about dumping its balance sheet. But still missing a piece here, but I think there's a little bit more information here to help me keep plowing ahead. Thanks for listening.